Hi everybody, this is Jill Gleba. Thanks for listening to our market update. This information covers last quarter through September 30th. So last quarter was tough. We have a lot of information to cover about what happened. So here are the topics: China and global trade, energy price impacts, economic growth, where will it come from in the future, Fed and interest rates, returns and valuations by sector, and understanding alternatives. So this is an asset class chart, and you could see on the top left year 2000. It shows that commodities did the best that year as an asset class, and on the bottom it shows you emerging markets had its worst year. And if you scroll all the way across on the right, not to the very end, but on the YTD year to date, it's showing you that fixed income has done the best, and on the very bottom, commodities have done the worst. So that's how you read it. And it just shows you that the weak returns as of last quarter. Cash is one of the best asset classes this year. High yield, diversified portfolio, the U.S. equities, and other developed markets are all down. The worst performing assets are commodities and emerging markets. The commodity and emerging market problem has a lot to do with China, and the weakness in the U.S. may have to do with the Federal Reserve. So this is the cyclical indicators in China. Vehicle sales in China have been booming from 14 million in 2011 to 20 million in 2014. Vehicle sales have slid to about 18.8 million this year. China was investing too much money in residential construction, so home prices were falling. Home prices have stabilized, but home building itself is down 18%. The bottom right of the page shows the export sector. As of August, exports are down 5.5%, with imports down even more. This is causing a serious problem in the Chinese economy. The top right shows PMI indices. There's been a big slide in manufacturing. However, the services sector, which is more important than manufacturing in China, is still growing. So when we look at this page, it seems hard to believe that China is still growing at 7%. Global financial unease is partly due to the fact that China is slowing more than the government is saying. So this is economic and policy snapshot of China. Despite the sketchy statistics coming from China, investors should not overreact. China is not collapsing. China has 3.6 trillion in foreign exchange reserves. Their currency is actually too high, and it's been tied to the US dollar as it's got too high, and the Chinese decided to revalue their currency. This caused instability, so they stopped. China has foreign reserves to manipulate their currency so they can bring it down or leave it where it is. They don't have to worry about a run on their currency that they can't control. They also have the monetary policy tools to stimulate the economy. Chinese leaderships want the economy to keep growing at a steady pace, but they also realize that in the long run, China has to move from being manufacturing and export intensive to a services intensive economy. If they could do one thing to speed up the global economy, they could do another bout of infrastructure spending, but this would cause a buildup of more debt. So overall, China has the capability of preventing a meltdown, and for a U.S. investor, you may have a problem if you're buying A shares. If you're investing in global stocks and bonds, which is most of you, it's not much of an issue. Here's global trade. There's 4 sets of countries that could be affected by the Chinese slowdown. First, there's commodity producing emerging markets like Russia and Brazil. This page shows that Russia and Brazil export a fair amount of their GDP to China. The drop in commodity prices have resulted from the Chinese slowdown, and excess capacity is hurting the Brazilian and the Russian economies severely. This is less important for India, which only exports a small fraction of its GDP to China. So India is a big commodity importer and is actually a beneficiary of lower commodity prices. This is also less important for Mexico, which has not been hurt as badly. Another area to look at is countries that surround China and that are tied to China's manufacturing engine. Korea, Taiwan, and Singapore are all big exporters to China. In addition, developed countries such as Canada and Australia are getting hurt, but not as badly. We actually expect Canada and Australia to bounce back in terms of GDP growth. Lastly, developed countries are the biggest part of the global economy. The U.S. exports less than 1% of its GDP to China, and the Eurozone only 1.5%. A slowdown in China is not enough to sink these big economies. This is our energy price impacts. Energy had a bad quarter also. This slide shows oil importers and exporters. India spends about 5.5% of its GDP just importing oil. If oil is being held down by a slowdown in China, that's actually a big positive for the Indian economy. It's also positive for the U.S. economy, which is still a net oil and commodity importer. It's even bigger positive for France, Germany, Italy, and Japan, which spend more of their GDP importing foreign oil. The main point is that the slowdown in China is not necessarily hurting developed economies. Here's economic growth and the composition of our GDP. The box on the left side shows that second quarter growth was 3.9%, which is pretty strong. This may be overstated, and we expect the U.S. growth in the third quarter about 2.5% or even less. What's going on in the U.S. right now is consumer spending. Consumer spending grew by 3.6% and can grow by 3.8% in the next quarter. So here's some cyclical sectors. The top left side shows that the third quarter was excellent for light vehicle sales. Consumer spending and housing are also doing very well. Government spending is doing okay, while state and local governments have only recently picked up hiring. Investment spending is doing okay outside of the energy sector. So if cyclical sectors are doing pretty well, why isn't growth picking up? There are three problems, two of which are temporary: an inventory cycle and trade. What's the problem with trade? The U.S. dollar is soared, hurting exports. We are likely to see the largest trade deficit in 7 years in the next quarter. Now the inventory problem, global manufacturers have increased output over the last 9 months. Consumer spending is picking up on services, but not manufactured goods. So we ended the quarter with a lot of inventory. If it were not for trade and inventory drag, GDP growth would have been about 4%. However, these effects are temporary. Inventories could fall within a quarter or two, and as long as the dollar doesn't go up anymore, trade will not deteriorate badly. As we move into 2016, we expect growth to be about 2.5–3%. Here's unemployment and wages. The September unemployment report was disappointing. Wage growth was also negative for the month. The average work week also fell by 1/10 of an hour. We have become accustomed to 200,000 jobs added every month, but if the economy is only growing at 2%, we're not going to sustain a 1.7% job growth. The unemployment rate has actually continued to fall. The reason is that the labor force fell in 3 out of the last 4 months. The main problem here is the demographic of structural problems, which are slowing down labor force growth. Job growth is still well above the growth of the labor force, and that is pushing the unemployment rate down. We believe that the unemployment rate will stay low. So the Fed and interest rates. We believe the Fed's decision to keep rates unchanged in September was a very bad one. The problem with it is that the markets hate uncertainty. The Fed sees weak demand growth and weak job growth as a symptomatic of a cyclical problem in the economy. We don't believe it's a cyclical problem. We think the economy is not capable of growing that fast. Anything over 2 to 2.5%, the economy would overheat. The Fed is also worried about what's going on in China. However, we don't think China really negatively impacts the U.S. economy. The Fed is also worried about volatility in the markets, but what are they doing is actually contributing to the volatility. With their September announcement, the Fed basically changed their criteria for raising rates. They have said it's about confidence that inflation is going towards 2%, but they decided to wait and see. They are still seeing one more rate hike this year. We think the first few rate hikes will actually stimulate growth. Here's the S&P index. The stock market has sold off quite a bit in the third quarter. However, it's still up 184% from its low in 2009, and we've recovered more than half of what we lost last quarter already into this quarter. Here's corporate profits. It's been a bad year for earnings, which have been down all year. The top left side shows that an expectation of $28.61 in the third quarter. The bottom right shows that the average quarterly number is between $2.50 and $3. Energy contributes to about 1/10 of earnings in the total S&P. So energy earnings in their own would have given you about a 10% decline in earnings. Since we're down so much over the last quarter 2014, 15, the energy sector more than explains the drop. The top right-hand side shows that the dollar's up about 18%. Since 48% of the S&P revenues come from abroad, currency depreciation amounts to about 6%. That was the hit on the corporate profits. The earnings may have to wait until next year to rebound, but the outlook is quite bright. If the dollar and oil are flat over the next year, we may see double-digit earnings for next year. Here's returns and valuations by sector. Where should investors invest? This page shows that all sectors in the S&P 500 and their correlation to Treasury yields. The main point here is that a lot of this depends on your view of interest rates. If you think interest rates are going to go up and the stock market's going to go up, then you should be invested in financials. Financials have the biggest beta in the S&P and are also positively correlated with interest rates. Now, if you think the market's going down and rates will be flat, then utilities may be the way to go. If you don't know where interest rates are going and you don't know how to invest in equities, you just wait and see. This is one of the main things that's holding the market back. Here's international equity earnings and valuations. This page indicates why investors should invest globally. On the right-hand side, we show PE ratios, which are at average levels. On the left side, we show earnings, which in the U.S. are up close to 30% from their peak in 2007. And Europe earnings are down 40%, and earnings for emerging markets are down about 27%. So Europe is growing and still has years of growth ahead of it. So while we're seeing the effects of the commodity cycle in emerging markets, commodity cycles don't last forever, and earnings will eventually pick up. Here's understanding alternatives. If you add alternatives to your portfolio, it appears to give you a better risk-return trade-off. In the last 5, 10, 15, and 20 years, private equity has outperformed public markets. The bottom right-hand side, it shows the hedge funds give you a downside protection. They don't participate as much in the downside in equities as the upside. So fixed income also appears to give quite stable sources of returns, and this is a market where investors need to be as diversified as possible. These are annual returns and the intra-year returns. You see all those red dots? That is how far the market went down in each particular year. But you could see that each year the market didn't end up that low. It actually ended up, in many cases, a lot higher than what. So the market may have gone down in the middle of the year, but it recovered enough that the year ended up a little bit better than its overall low for the year. So this page can help you understand that some amount of volatility is normal. The biggest drawdown we see is what occurred in the third quarter, which was 12%. Over the last 35 years, the average intra-year drop is actually 14.2%. So despite this average intra-year drop, equity returns have been positive in 27 of 35 years. While there's a lot of uncertainty and negativity surrounding China and the Fed, the volatility that has resulted is normal. So if we can get past this uncertainty, there are many investment opportunities around the world. How we can help you is to keep your portfolio diversified, pick up top-notch managers to manage your money. Remember that patience is a virtue, and we suggest that you stick to your goals and keep investing for the long run. And as always, we encourage you to call us and ask us about your portfolio and how it's invested. So take care, and thanks for listening.